Welcome to yCITIES Inside the Mind of an Investor series. yCITIES cultivates an intergenerational innovation ecosystem from middle schoolers and beyond, supporting a diverse pipeline of tomorrow's founders and investors. Investors are a vital part of the startup community, and while there are plenty of resources about how to pitch or how the process works, it can still seem a little bit like a black box as to why an investor chooses to invest or not only to the founder, but also to peer investors. And so we decided that we wanted to have many conversations with many different investors and to focus on only one investor at a time. Every interview is anchored by the same 5 questions, but each conversation is shaped through the follow-up questions influenced from the different lenses of our panel of hosts. Today, I'm super excited to introduce our guest investor. Welcome, Raza.
Vicky, Isabel, Ronit, and Sean, thank you for having me.
Hey, we're glad to have you here, Raza. If you can start off by telling us a little bit about how you got into the space, how you kind of just a little bit of your journey. You know, I always like to now talk about the hero's adventure as I get more into Joseph Campbell. But if you could tell us a little bit about your journey to angel invest, to VC, to being a VC, a little bit about your thesis, and just kind of your point of view on the space in general, that'd really be great to start us off.
Sean, today I'm one of the managing directors at Launchpad Venture Group, a large angel group. I'm also a member of TBD Angels and Sky Ventures Group as far as angel groups go. I co-manage a small VC fund called Beacon Venture Partners with my co-GP, Alex Brown. And I'm invested in other asset classes. So that's where I'm today. How I got here in a super, 60-second, landed as an immigrant on an H-1B, did tech consulting for a little bit, got bored with that, joined a startup as an early employee. That startup actually did very well. Did a gig at the Broad Institute of MIT and Harvard. It was super fun. Started a company building iPhone apps and games when the iPhone was new. So you can date that company a little bit. And ultimately started my last company with my partners, which is a cloud consulting company heavily aligned with Amazon Web Services. We kind of just grew with AWS. It was based on the premise that things that are going to be built are going to be built on the cloud, and the enterprise needs help getting to the cloud. As I was doing that, I got involved with Mass Challenge to start with in the startup world. And this was the first year of Mass Challenge. And I became a mentor, a judge, and started helping these companies. And a couple of years into it, I thought, hey, maybe it would be interesting to invest in some of them as well. I started as an individual angel first, but very soon realized that is a lot of work, and I actually don't know a lot on how to do that. So I joined angel groups. As I worked with angel groups, I enjoyed this journey, very, very much, and started a fund with Alex Brown to just continue doing that.
So you started Launchpad?
No, the fund Beacon Venture Partner, Alex Brown and I started.
Oh, okay.
Launchpad has been around, now it's our 20th year. It was started by Ham, Lord, and Christopher Mirabile over the years. We didn't start it. We're part of, it has grown so much that it needs help in managing and running a large group that's very hands-on and has a thorough process. Alex and I both enjoyed this so much that we decided to help out running the group as well.
What type of companies were you drawn to initially when you were first mentoring, and then kind of had the thought of, maybe I want to invest? Was it something that was in the space that, you had worked in, or did something else kind of catch your eye because it was like a particular problem that people were solving?
As a matter of fact, it was kind of in the space where I had worked, the gaming company that I mentioned, games and apps company. My first ever investment was actually not similar, but they're working on a particular game, and I invested in that. And I think that's how you kind of get hooked. The next few deals were kind of what were in the orbit. Friends would tell me about, hey, we're investing in this company. So I didn't really have a thesis originally. And speaking of thesis, just to, say it, as an angel, you don't have to have a thesis. You're investing your own money, so, you can invest in whatever you want. Having said that, each one of us as angel investor or as even a venture investor develops a thesis over time. Mine is really a sector agnostic, is the first thing. Although I do tend to invest in things that I can understand, and that's kind of reasonably natural for most investors. The second part of my thesis is that I want to be connected and close to the company, as all of us claim to be helping companies. But for me, by implication, especially before the pandemic era, it meant that these have to be kind of local companies. Mm-hmm. So that becomes a second part of the thesis. I contrast it with somebody else who's perfectly fine in investing in companies in Ohio or Silicon Valley or anywhere in the world for that matter. But my own personal thesis, I like to be connected with the entrepreneur and the founders, be able to help. The third part of my thesis that evolved over time, I learned myself that I don't have the propensity for or risk tolerance for super, super early napkin and idea stage. As we jokingly call, it's a PowerPoint, 2 engineers and a dog stage. And whereas that is actually really exciting, and angels are one of the first to believe in the founders at that stage. Mm-hmm. I myself have moved a little bit later to that stage, and I look for, now life science is an exception, life science healthcare, right. Medical devices, but generally look for some early traction and some revenue before I invest. So I wouldn't be a good funder for... And the last part of my thesis is capital efficiency. Capital efficiency means that a company that we already know by definition is going to need hundreds of millions of dollars to succeed. We angels have learned the hard way many times over that may not be a good angel investment or investment for angels. And there's plenty of reasons for that, ranging from, hey, your pro rata is about 3 million if the company is doing very well, but you can't do your pro rata then. All the way to that every capital intensive company, even the successful ones, are likely to go through near-death experiences. Mm-hmm. And that is very, very, disruptive to early investors and even founders with, if they, God forbid, have to do a flat or a down round. It's really brutal. And there are many, many other ways. And most of all, the golden rule in investing is that that who has the money makes the rules. And there are many ways for later stage investors to be renegotiating with early investors. I personally look for companies where I think I can follow along if they're successful in making progress for quite a while. And maybe even that the company may not raise full VC or maybe raises strategic or specialty VC all the way to exit. So that's kind of like the closest that I can narrow to my own personal thesis. For investing.
I like that. I think not enough folks have brought up. I mean, it might be in their thought process, but I don't hear enough of it being articulated about the, how the capital efficiency piece of it. So I'm actually really glad you bring that up.
You mentioned like a couple of reasons why you might not go forward with an investment. But beyond maybe like a co-founder dog being present, what on a pitch deck really makes you take a second to pause? Like how do the teams demonstrate these things that you're looking for at an early stage without you thinking that they're too early stage?
I think for the first pause becomes, hey, does this fit with the big bucket checklist of my thesis? And if it doesn't, that's a right away. Okay, even though it may be a very interesting company or may even be a great company someday, but I'll just pass. We know we miss stuff, but I wouldn't look further. Once you have met your basic checklist. Hey, they're in the Boston area. They're doing early betas. They are in B2B software, and they're solving a very interesting problem. Then I think it really an investor process, or at least the process that I approximate, is finding the narrative. What is the problem? How is this team solving that problem? Who are their customers? Why are they buying? Why they would be buying this? And how high is this in their priority of needs that the customer has? How does this go to market? Does the team have a credible plan for that? And looking at the financial model of like, how does this thing make money or potentially make money? And lastly, we investors are investing and we only make money until an exit. Until then, it's a interest-free unsecured loan to the company. So, those 7 or 8 bucket, you're trying to judge from the deck first, so that you can kind of see, hey, there is enough here that I want to take the next step and maybe meet the entrepreneur, maybe have them talk to our screening team. So I must also clarify. So there's the personal thesis, and then if I'm looking at a deal for TBD Angels or for Launchpad, then I'll also put the group's preference on that filter as a little bit, saying, all right, I'm not as hot on medical devices, but I know a lot of the members in the group, or food and beverage would be an example, maybe for TBD, where I personally don't do food and beverage, but plenty of great members at TBD would love to look at those deals. So I'll filter it from either my personal perspective or from the perspective of the group, and then route the deal to the next step, either personally meeting with the founder or connecting them with a screening team or a scouting team.
Can I ask you 2 follow-up questions? Reason being, so I'm working with my founders currently and trying to get them investor ready, as we call it. For those other people who are listening, who are trying to put a deck together, trying to think of how to approach an investor, 2 questions. So how many decks do you get a week that you have to go through? And then on average, for that initial run through of the deck, in order for you to decide whether or not to take that actual pause and meet with the founder, about how long do you spend on that deck, in the sense of like a minute? Because if it's over a minute, then you're like, these people don't have their business down enough, or they're not able to articulate the problem they're solving.
So I haven't really counted, but I would imagine, and I'm guessing from the total inbound on LinkedIn, my email, my fund, I probably see at least 10 a day that are inbound or referred. Mm-hmm. For us, for me, because the thesis is a little defined, right off the bat, it's pretty easy to filter through most of them. The quick glance on the email that came in, and if it is, a company that's really outside the geography, that tends to just make it super easy. Although I would then still read the email, even look at the deck for a few minutes to see if I can connect them with any other investors that may be interested in that area. Typically the deck, I do go through the entire deck. So 15, 20 slides or a little more, maybe, a few minutes to 5 minutes per deck would be quite typical. You're trying to, you want to be very open, because you just don't know at that stage saying, well, I whatever. I don't want to look past the second slide because I don't like the problem space or whatnot. You're looking from multiple angles, from your angle, from your groups that you're involved with, their angle, and see if it could be a fit. For example, an AI based company that's on a vertical solution comes in. Turns out they're in Austin, Texas, but looks like a great company. So I would still connect them with Glasswing or other individual investors, and even TBD, as they're not as restrictive on geography. Yeah, but it is a big part of the day. Like you get a lot of inbound, and you have to come up with a kind of like a system. In some ways, it's like a whack-a-mole game, but in other ways, I think folks who are preparing the deck and trying to get ready for investors need not worry. People do read their decks. That's what they're there for. They are looking for deals that are suitable for them. Now, for each one of them, that means a different thing. But I think everybody actually really gets a good, reasonable shot. It's not like we're so uptight that we only want to spend 30 seconds. And if it doesn't get me in 30 seconds, I'm not going to look at the next slide. So for what it's worth.
So on that, I'm sure a lot of the times you'll come across decks where you see it's a great business, like maybe it's doing great as a business, but it's not really the best investment for you for a variety of reasons. And investors have different reasons for that. Maybe because they don't like the exit prospects, or other reasons we've heard from a bunch of different investors. So for you specifically, what makes a company maybe a good business, but not exactly a great investment for you?
Yeah. Well, actually, the saying goes that not every feature is a product, and not every product is a company, and not every company is a good investment. Specifically for venture investing, angel investing is a type of venture investing where we're investing in early stage ventures. We really come from it from an exit point of view. And to make the example like really extreme and easy, a coffee shop at a great location with superb coffee can actually be a really good business. But it's not a venture scale business. There's an upper bound to what a coffee shop can produce in profits, and can't really easily grow. I mean, there are, of course, Starbuckses of the world, but generally speaking, don't grow on a hockey stick curve that you expect from high growth companies. So a coffee shop investment may be a great business, but might not be a suitable investment for venture investors. In the tech world, you would see examples where a bootstrap company has decent revenue, but they have great customers that are sticking with them, but their growth is what you observe and what you think is likely is relatively flat. They're growing 10% a year. So whereas they think that they are a high growth company, but in judging that company, you come to the conclusion that it's not very likely to be the way that particular market works, the way their go-to-market is. And then that's where you would hear such a comment saying, this may be a great business, but may not be a great investment.
Got it. And so what kind of exit are you usually looking for? Are you mostly looking for acquisition? And if you are looking for an acquisition, do you usually help the founding team get to that exit? So maybe matching them with a buyer or something like that?
Yeah, so good question. IPO versus acquisition. Like you hope as an angel investor, like a golfer, the hole-in-ones are very rare, even for great golfers. So an IPO is kind of like that. You may get them, a few of them, or one of them, if you're lucky, or two of them in your angel career. So it almost certainly is always acquisition. Because there's a high failure rate in startups, no matter what you do, there's no rule of law against failing. That's what it's all about. You're trying to build a business. You had a thesis, you had a product, you were solving a problem, it didn't work. The failure rate can actually be as high as 70%, and failure rate I'll define as for the investor, the dollar invested returns less than $1. And in actually 20 to 30% of those investments, that less than $1 is zero. So because of the high failure rate, and this is an asset class where 90% of your returns are going to come from 10% of the top companies that you invested in. When you do the math for your own returns, you have to believe that the company that I'm investing now I'll do a rule of thumb, most investors would say do a 10x return, potential at least. So the exit that most investors would at least do the mental simple math saying, can I foresee this company that I'm investing today at $5 million valuation, someday selling for 50 or $100 million? And if I can see a path or understand or believe or kind of at least say that that's what needs to be believed, then I would say, that might be a good possible investment. Regarding
timeline on that, like, because depending on how long they have to return on it, obviously being an angel investor, it's a little bit more of like your actual cash in your bank account. Do you have a timeline on when you would expect a return on investment?
We know and expect from experience that these are some of the longest time horizon investments in any asset class. It is not uncommon for real value in companies to be built 3, 4, 5, 7. I just heard from one of our VC friends that one of their actually most successful investment is 16 years in and has not exited yet. It is about to exit, hasn't yet, but it's 16 year in, but it's superb investment. You can simply imagine that if a company is to be sold at $1 billion valuation, even at a really exciting 10x multiple on revenue, they need to be at $100 million revenue run rate to be acquired for $1 billion. So, we're very patient. We're one of the most patient investors. We're the earliest investors, angels. We do occasionally see early positive exits, 2-3 years into it, sometimes 12 months into it, somebody acquires. Those are actually rare. And we actually see more negative exits early on. So we investors have to deal with the dreaded J curve where your portfolio value is actually negative for a while and you're like, why am I doing this in my 3rd, 4th years as an angel investor? And regarding, Ronit, your question about do we help with exits? It really depends on the group. Launchpad, I'll take the particular example of, we do ask for a board seat and a board observer when we lead a round. 40 of our Launchpad members are on at least one company board in our portfolio. So that actually really becomes a way of helping and engineering an exit. Good exit don't happen by accident. Contrary to whatever you hear that, all of a sudden somebody came in and acquired them, that's an exception. Generally, you actually have to really think about who would buy you, why would they buy you, and where does the company need to get to for that to be an attractive acquisition. And through the journey, the board guides the company often on developing those relationships with potential acquirers, whether it's be partnerships or at least coming onto their radar and so on. So, good exits are made and usually don't happen by accident.
So kind of in an effort to reach that kind of exit in the end game. So you mentioned you like to invest a slightly later stage rather than napkin kind of stage. Are you the kind of debate of is it the founder or is it the size of the problem? We've had some investors who said, well, it depends on how early it is, because the earlier it is, it's one answer, and then the later it is, if it flips to the other as far as importance for them. given where your tolerance is, and then because we've had different answers on how big of an exit they look for, because as angels, they're not necessarily bound as venture capitalists are. Given your situation, where do you fall in that debate, knowing that everybody's going to say, well, it's a little bit of both, and but in absolute
well, of course,
terms,
it is a little bit of both. But even at our stage, or the stage that I invest in, it is still team, and team for the number 1, 2, and 3 spot. Now we often have this debate of the analogy of the horse or the jockey, betting on the horse versus betting on the jockey. We almost always bet on the jockey. The horse, in this case, evolves and changes, and things have to be figured out. Of course, there has to be like the necessary but not sufficient condition of, there's a big and a great market for it. But in that balance, it's always the team.
We've had some other investors speak to this around it being centered on a team. We actually had one tell us something like kind of, I'll just say, not shocking, but interesting, where she mentioned that when somebody says they're betting on a team, that there is some code around resilience. There's some code around their ability to kind of really weather the storm, and that they may be the composite to do that, like the group to do that. That can mean like they have other backing behind them to help them, like, get beyond ramen every night. When you think about the team, what are the elements that really come to mind that say, it is these factors within a team that for me catch my eye? Like, how would you put your thumb on that?
Yeah, and is that part of your traction? Because you said revenue and other traction. Does that fall under your traction checkbox for the founders too?
To some extent, that they've shown, demonstrated progress. But I think it's a great question. Everybody says team, but what does that mean? Yeah. And I must also say that everybody looks at the elephant in different ways and may have different conclusions. This is actually a pretty special bunch that you're looking for. I mean, on one end, you want good IQ, but also EQ. You do want to see signs of resiliency, grit. You are looking for signs of does that team work well together? And we've come up with a great leadership assessment process. It includes talking in a very particular manner or in a particular questioning for the references the team has provided, and also finding blind references. We really, actually, one way of leveraging that knowledge, like I'm only, introduced to the founder, in a short amount of time. But one way of finding about who that person is to talk with people who have known them for a long time. So through various questions, which sometimes actually for founders would say to us, it sounds like sitting on the therapist's couch and looking at even the interaction that we have had as investors with the founders through the journey. Somebody in the group met with them, they went through the screening committee, they did the main form pitch, somebody took a tour of their facility. We actually get a lot of data about the team, and even that, how well we as investors will work with that team, and vice versa. It's actually an opportunity for the team to vet their investors and whether they would work well with those investors. So I'd say there's a good process for judging leadership. There's no right or wrong answer. There's always an exception for every rule that anybody has come up with. We try to leverage others' knowledge on the person, and we try to kind of come up with a mental picture of what we feel or believe about the team through our, sometimes that interaction is 6 to 8 weeks in duration, and you've had plenty of interaction. People have come up with other heuristics. For example, there's one around distance traveled. How far they have come from is a heuristic on how far they might be able to go. And other, anecdotal things for judging a team and finding signs of how the co-founders are interacting during the pitch, or how the questions are being passed along or handled, and so on. I'll just give closing thoughts. Like this mind of the investor is like a really great idea that you guys have. What I say that it's not a single mind. In other words, like I always say that finding the right investors for you as an entrepreneur is a matchmaking game. It's like finding the mate or a dating game. And in that respect, the question of what's behind their mind is similar to like, hey, what are they thinking when they're dating? And what's their list that they tell you, and what's the list they don't tell you of things that they keep to themselves. So I think in some ways it's a similar dance between founders and investors, and a very inefficient, inaccurate process of coming to that match.
Yeah,
for what it's worth. Yeah.
Yeah, no, definitely. I agree. And I think that, definitely the angel community can learn from each other this way. And certainly, we've been really unraveling some just, trying to understand beyond because right now the assessment is sort of like you either get invited in or you don't. And then everything else is a little bit of a guesswork. So, on that note, this wraps up another episode of Inside of the Mind of the Investor. And thank you so much, Raza, for joining us today.
Thank you guys for having me.